What's going on, guys? So, this is going to be a video on how to trade economic data, right? So, when it comes to understanding and how to trade economic data, it really just depends on what are you trying to accomplish, right? Because I'm just going to speak of it from my standpoint, like how I like to look at data and what I look for opportunities for throughout the week, right? Because when it comes to the markets, like I like to focus on fundamentals, right? So I pay attention to the direction of the currency or whatever asset based off of central bank analysis. Which direction are they trying to push that currency, right? So if this data comes out, is it going to strengthen the currency or weaken the currency? But also, does this data have significance towards the central bank's monetary policy, right? Because there's a lot of economic data that comes out, but how do we know what is important to the markets? So this is where like having a broad understanding and paying attention to central banks because they actually give us clues during their rate decisions or even when they speak, they tell us what they're paying attention to and what are they looking for in order to make an adjustment in their monetary policy. So that's why it's important. Data is just not random. There are data, certain economic data that comes out that has more importance than another piece of data because of how it impacts monetary policy. So when it comes to economic data, right, when you're approaching an event, you have to know what the event is and pretty much what it impacts. What is the data about? So is this data inflation? Is it growth? Right? Is it consumer sentiment? Is it housing data? So first you have to understand what is the data. So like an example, Forex Factory I know is very known to a lot of people, right? A lot of traders look at Forex Factory. We also got trading economics. I believe there's also another one like Bloomberg is a good option for a lot of people. And what else? I think that's really it. Like me, I like to use my terminal, right? And I like to, use a terminal because what what you don't get in the free version is something called the low and the high expectation numbers. And I'm gonna go through that in a minute. But first, when like say for an example, let's prep for this week, right? So when you're going through economic data, you could tell like right here we have PMI. So you want to know like what is PMI for somebody that's completely new to this? It's like okay, what is PMI data? So sometimes you could just click like you could click the it should be a link or like right here. You could click it, just go to flash service, right? And it tells you what it is, right? So indicates industry expansions. So it's just a leading indicator of economic health. Businesses quick react to market conditions. So right there, you say is a leading indicator of economic health. So right away, you could just tell yourself, oh, this is growth data, right? So this is growth. Now, if I understand that this is growth data, if we get a stronger print in growth, would that be good or bad for the markets, right? So now you can ask yourself that. So obviously, stronger growth should tell you positive, right? And you want to see a stronger print because when you're looking at a graph, like usually the free versions, you just get the actual, the forecast, and the previous. So before the event, you're getting the previous, and then you get the forecast. So typically, the previous is like what happened last month's, what happened with this data last month. The forecast is just an overall number of all the institutions, right? Like hedge funds and banks, they give their expectations of where they think this actual number is going to go. And it kind of looked like something like this. Like this is an example. This is UK GDP. So this is the 3 month, right? As you can see, these are the numbers, and these are all the banks given their expectations of where they think the number is going to go. So the zero point 0.3 is like that's just the median because that's where they all have their expectations. So that's how they come up with the forecast. So when you're trading economic data, you want to see if the print is going to go above the forecast or below it. So, an example, if we understand that this is PMI data, and if it comes out higher, right, you want to typically see it come out above a 51.2 for services. And manufacturing, you want to see it come above a 51.9, right? We're looking at US PMI for an example. So if we get that number to come out higher than the forecast, typically what you're going to see is a high probability you will see strength in that currency, right? Because the actual is actually higher than the prediction. So the forecast is the main focus because you want to see the number actually go higher or lower than the forecast. So if PMI data comes out above the forecast, typically you could expect a stronger currency out of that event, right? And sometimes stronger equities because this is PMI and we know that this is an indicator of growth. Strong growth, you have to ask yourself, is it good for the stock market or is it bad for the stock market? Is it good for companies or bad for companies, right? Good growth typically is good for the economy, right? So this is why you could get a direction in the markets, right? So that's how you could learn to take advantage of the print. So now, second, if the data comes out below, right? If it comes out at a 50 or 49, right? Then you have a better expectation, like, oh, it's bad. And some platforms you actually get a color, like I show you the previous week. Like it comes in green and red. So when it's red, like right here, we look at retails for the US, right? Now it's red. So you could get an idea that it's actually bad. It's below the forecast. So when you get bad data, right, it typically can weaken a currency. But this is also just strictly off of economic data growth, good and bad, right? So, because another reason too, just to make it more complex, some people will say like, "Hey, I was trading data like an example. I was trading pound CPI, and it came out lower, but the currency got weaker. But how come the equity markets, the UK 100 got stronger, right?" So when you coming up to CPI, what is CPI data? So you have to ask yourself, you make that all right, consumer price, right? Majority of overall inflation. So now you know that okay, CPI is inflation data. So it's different from growth data. CPI, right? Inflation. So what does inflation really impact? Remember earlier when I was talking about central banks, they make their monetary policy decisions off of economic data. So weaker CPI enables a central bank to want to cut rates. So when you get that lower CPI number, it would most likely to weaken the currency because weaker inflation would contribute to a central bank leaning more towards rate cuts. Cutting rates weakens a currency, but also cutting rates will strengthen the equity markets, will strengthen stocks because lower inflation is good for stock growth, right? So when you're looking at data, you have to understand what is that data and how the markets will react to it from a monetary policy perspective, or are they going to react to it from a sentiment perspective? And the way you really going to get a full understanding is one, trading it every month repetition and paying attention to the central bank's decision making after the event. So, and I would speak to this current time because going 3, 4, 5 years like in the past, back testing economic data is not going to help because 3, 4 years ago, you don't know the central bank's monetary policy position, right? Because an example, when we was trading PMI data 3 years ago, right? This PMI print could have been reacting from a monetary policy perspective. Like if we had stronger PMI, it would strengthen the currency, but it could have also weakened equity markets because central banks was looking at growth from a decision point on monetary policy. Compared to like today, central banks is not looking at it this way. Strong growth is not contributing to higher inflation, right? So that's what I mean. Like 3 years ago, Was strong growth contributing to higher inflation or weaker inflation? Or they're just looking at it from a growth perspective, risk sentiment perspective. Bad growth, recessionary fears. Good growth, positivity. Everybody's happy. So understanding the current monetary policy decisions, right, is what's going to help you. So this is why I said like paying attention to it now and moving forward is the best education that you can do. So starting now, we understand that when we coming back tracking inflation data is strictly focused on this is what the central banks are reacting to from a monetary policy perspective. So if you're trading GDP CPI, right? So we understand that this is inflation data. So now we know that the central banks focus on this inflation data and the markets react to it from a monetary policy perspective. So now if we see that the previous is 2.9, so they're expecting inflation to lower. So if we get this inflation print that comes in for the UK and it comes in at a 2.8 or a 2.7, we know that it's going to be red and it's lower inflation. So now it gives us an opportunity to look for a weaker currency, a weaker pound currency. So then that's where you look for yourselves when the data comes out, right? And then we could understand that, okay, it would weaken the currency, but the UK 100 equity markets will go higher because this is going to give us a dovish reaction in the markets because this is CPI. But if we had an example previously, we had UK GDP. So this data, we understand it's growth. So GDP is growth, right? So we know that this is just growth data. This is not inflation. So with a weaker print there, we'll also get weaker equities, but bad GDP is also signaling recessionary fears. That is also bad for the equity markets because growth is bad for the stock market. And yes, it would contribute to them it would contribute to the Bank of England wanting to lower rates. But then from the market perspective, understanding that this is bad growth, that is also bad for the stock market in general. So that's how you could understand the difference, right? So when you're trading these events, that's how you want to really approach it. First, you have to look at the event and understand what it is. And then you could get an idea on how the markets will react to this event based off of what it is, right? So, if, like an example, like US data, we have new home sales. Does this have any significance to the market, like market reaction? Typically, no, because we never really hear Jerome Powell or any central bank member that comes out and says, well, we will make adjustments to our monetary policy if we see that homes data is actually declining. Like you don't really hear them say that. So that's how you know if what data point has significance. And then also the folders kind of give it away as well. Red folders show you that the data is more important than others, and orange folders also show you this somewhat importance. Like durable goods for the US is an orange folder, but do we really get a big market reaction on durable goods? Not really, because again, durable goods is not impacting monetary policy. All right. So, but we see that we have that same orange folder, but it's for GDP. And then we see we got that same orange folder for CPI. But we understand GDP is growth data. So we know that, okay, even though it's orange, but me understanding that GDP is growth data, that should have importance for the markets. And Tokyo, this is CPI, it's inflation. So even though I know that it's an orange folder, but I know it is important to the markets because I understand that it's CPI. Okay. So when you're looking at data, like this is what helps you also prep for opportunities, right? Because it gives you a time and a session when there's an opportunity for a trade. Because typically, like before a big event, right? Like typically before a big event, sometimes the markets will not give you any reactions and consolidate because it's prepping for this important event coming up. So then after the event, you see a big impulsive move because that's what the entire markets is waiting for. So that's how you could literally capitalize on opportunities if you could understand how to take advantage of some clear good trades, right? So sometimes, like when you're looking at an event, and I had this calendar, I had this here, right? Because like an example, this is trading economics, right? Same, like you can look at all platforms and it gives you economic data, the forecast, and the previous. That's what they really give you. But sometimes, like an example, this is core inflation, and you want to the this goes by the previous. It tells you the trend of inflation, right? Like how inflation has been since 2024 all the way to 2025. So we can see that the trend of inflation is actually declining. But how do we know if it's, like how do we know, how can we use, this type of data for our advantage? So this is what central banks pay attention to is when they're focusing on something like inflation. They want to see how is the trend of inflation has been going. Has it been declining or increasing? And they're using every month economic data point that comes out. So if they see that this is why the Bank of England has been cutting rates because of 2023 all the way to 2024, inflation has been actually falling from the high of 7.1%. So this helps you with a bias, right? So if you're trading CPI data and you see that inflation is coming lower, now you have an opportunity to trade in what direction. You look for sells, right? Because now I understand if inflation is actually lowering, this will increase the odds of the Bank of England cutting rates. So you could look at this trend right here, and then you can see, well, if inflation is continuing to decelerate, heading towards their goal, I want to see another weaker print because now that gives me a better tradable opportunity. But now, if I go to the 1 year, look at inflation now since December to 2025. It's actually increasing. We're seeing a break of structure in the trend. So now, this is why in monetary policy, the Bank of England is still restrictive. They're not in a cutting cycle, they're pausing rates because they're afraid of the uptick in inflation, right? So if we get a higher print, which direction you think that currency is going to go? Higher or lower, right? So now if we we got CPI coming up. So if CPI comes out higher than expected, it gives you an idea to want to buy the pound currency, short the equity markets because now markets is going to expect a hawkish reaction, right? A stronger currency. They're going to expect the Bank of England to stay restrictive when it comes to rates because now I can see that the trend of inflation is going up. So that's a good example. And this website is Trading Economics. And literally you could do this to any event where you could like whatever pair. So like an example, I just do jobless claims this every week, and then you can just click this chart here, and then it gives you an overall view of how inflation has been, how jobless claims has been going, right? So when we see jobless claims, like we understand that's labor data, that's job data, just like NFP, right? Just like unemployment. Like I'm gonna give you guys a list, of data that's important for the markets. Okay. So you could write it down. So CPI, right? And I get this question a lot too, because CPI, you get the monthly, you get the yearly. So you get headline, and then you also get core, monthly and yearly. And people say, oh, which one is important? They're all important. You want them all to be in the same direction, showing high inflation or lower inflation, right? Because when you're taking a trade, you want to take advantage of a tradable opportunity with the best edge, where all the data is showing you inflation is higher or if inflation is lower. Okay. What you like, so an example, because I like to leave the notes here for people in a private group every time when we trade in events so they could take it for their notes, right? So when you look at here, the CPI print, everything is in red. So you want to see core CPI and headline CPI coming lower. What's the difference? Like core CPI is more of what the central banks can control. They control that. CPI has other stuff that they can't control, like rent prices and food prices. I think is gas and electricity. So they can't control that. So that's why they focus more on core. So this is what you want for a print lower, right? So that you could take advantage of a weaker currency. But if this came out mixed, so say that if core and like core yearly and monthly came out lower, but then headline monthly and yearly came out green, right? If this came out green, came out higher, that is considered mixed. When you get mixed data, you don't want to trade it. Leave it alone. It's not giving you an edge. It's not giving you a direction. Okay. So that's why, like, if you look at a print and if you cannot tell if it's good or bad, then it's just a higher probability that it's not worth trading. So that's how you know how, to stay away from economic data is when it comes out mixed, or if it comes out the same as if it comes out the same as the forecast. So let me see if I can find another one here. But yeah, because understanding the stuff is what gives you a better edge. This is like non-farm payroll, so I'm going to do this here. So when you look at non-farm payroll, right, we get non-farm payroll every first Friday of every month. And when you look at this print, you understand that non-farm payroll is mostly labor data, right? It's job data. So you have an understanding this is about growth, right? Labor data is about growth. It's not inflation, right? But when you look at earnings, when you think of earnings, you think of wages. So that's inflationary. So that's something that you want to focus on. So when you're trading non-farm pay like NFP data, yeah, you want to see everything come out in the same direction, everything come out red, right? Because say if unemployment is bad, non-farm payroll is bad, but then earnings is extremely strong. That's an event that you can't trade because you have inflation is actually higher, but then you got labor markets that's actually weakened. So when it comes to a monetary policy reaction, you don't have an edge. So you don't want to guess what's going to happen, right? So those are the opportunities that you have to learn to stay away from. And that's the best part because when you know when not to trade, that's when it makes it easier for you to understand what to trade. Okay. So having to understand what to stay away from is actually key. And that's important, right? Trading non-farm payroll is important. So that's why I wanted to cover this. So now let's just go to we went over the forecast, right? We went over the previous and the actual. So usually what helps us get a better edge is having this high and low expectation, right? Because again, when I showed you that chart of those expectations, the high is just the outlier of because majority of these companies, right, there's hedge funds and banks, they give you an estimate of where they think that number is going to go. So maybe one bank was think that 300K is going to hit, right? Or maybe they thought 250. So if non-farm payroll goes above 300K, so if it says like 325, you will get a surprise. Those surprise numbers is where you get the most volatility. That's where you get the no-brainer direction in the markets is when it's an actual surprise. That's where you get the best trades. So if you're looking for a no-brainer opportunity in economic data, you need to see that low and that high expectation get broken. So say if non-farm payroll came out below 30 and it came out to 25 or 10, right? That's where it will turn red and you will get a thunderbolt next to it. And that's how you know it's an actual surprise. And you get an aggressive move after that. How some people is like, damn, like some moves are very quicker than others is because of that. And in some free platforms you don't really get it, but when you pay for it, like you could use Reuters, or if you join somebody that actually gives you this information, right, it makes trading a lot better. It helps you get a better edge when you're trading economic data. So like these are tips just to help how to read economic data, but also taking trades from it. We'll pretty much do it later, but here's an example, right? So when data comes out, right, you could have like an order block. So obviously, when the data came out lower, you would expect dollar to start pushing lower. Then you will see equities like Nasdaq, US 30 will push higher. Then with that weaker dollar, you will see USD JPY push lower. GU, EU, and AU will start pushing higher because the data actually came out lower, right? So that's one of the things that I like to pay attention to. Okay, so that's how I like trade live, and that's how trading it makes it easier for you as a trader, right? You could because you are able to take advantage of the most clearest opportunities. So again, so now help you guys throughout the week, like just give it a shot. So pay attention throughout the week. So say if you're focusing on a pound currency, you like London session, you trade pound pairs, right? So you understand that, okay, Monday I got PMI data, which is going to be at 5:30. So at 5:30, just try to watch the data and see how it comes out so you could get an edge. Governor Bailey, you know that he's speaking at 2 p.m. and he's the chair of the Bank of England. He's the governor, right? So his comments on monetary policy is what's going to be important. So this is where you have to just pay attention to pretty much what is he speaking out, right? So head of the central bank, which controls short-term interest rates. So there you go. It shows you that he's the central bank. He controls the value of interest rates, which also impacts the currency, right? So then if you keep scrolling, okay, what else do we have any other pound data, right? I believe I saw that we had, yeah, like UKC. Yeah, so you can see Wednesday we have CPI. CPI is extremely important for any currency. So knowing that, those could be your two opportunities looking for a good trade. Weaker CPI most likely is going to be a weaker currency, but stronger CPI could be a actual stronger currency. So that's how you could really get an edge because when the data comes out, it kind of gives you an idea of what the central bank's next move is, and that's what helps you be this is what helps you trade with the markets, right? Because this is how the central banks make their decisions in a day-to-day basis is by focusing on these events. Okay, guys. And then like you could also focus on other pairs, right? Because we understand that Japan has CPI in Tuesday. So if you traded a pair like GJ, right, GBP JPY, you're also going to focus on Japan CPI as well, and it's going to react the same way. So this is a brief idea on how to look at economic data, the importance of economic data, how you could trade it, right? Because when data comes out, in your mind, you have to ask yourself if it's is it good or bad, right? And then the markets is going to actually confirm to you that the data is moving within that direction, right? Like, and here's an example just to help. So, say if I'm looking at USD JPY, and if we're trading in like any growth data that could come in mind, right? Say that we're trading GDP, and we're waiting this because it's easier to do this live, but just like an example, so you can understand the movement, right? So you could just see that we're stuck in this range, and then we get CPI data that comes out, and it actually comes out higher than expected. So before you take a buy, right? You don't just take a buy right away. You want price action to prove to you that the markets is actually following the data. So if it breaks above this structure, because we want to see a break above resistance, right? A break above a high, because then it's a higher probability that the markets is going to follow the data and follow within that direction. So the moment that you see the data come out, and then we could see an actual break above structure, like bam, that's where you start looking for your entries on your trades, right? Because now you have an idea that the markets is actually following the data. And that's what typically helps you be in the right mindset and be in the right trades. It takes patience too. Sometimes data, yes, could it be super quick? Yeah, but you're just looking for a break of structure within the direction of the markets. And when that actually happens, that's how you're able to take advantage of it, right? And it kind of confirms it because say if data comes out higher, but you don't get a break of structure and price action breaks below support. And if that happens, you know that, hey, this doesn't make sense. So if it doesn't make sense, right, you just stay away. And then maybe later on in the day, in a few hours afterwards, then you could look for price action like this and then break out higher because this data supports a stronger currency. So a weaker currency doesn't make sense to me. So that's typically how I stay away. So I still want my technicals to confirm with my fundamental bias. So if my fundamental bias is saying buys, but the technicals are showing sells, I'm gonna just stay away. I'm not gonna force the sells until I see that the markets is going in line with my bias. If I see that it's going against it, that's when I just stay away. Okay. Hopefully this was helpful, guys. If you like this video, you want some more, like, comment, subscribe. Also, you can follow me on Instagram if you have any questions as well. I'm always here for you guys to help you out with these type of content. And guys, trade. Make sure you just kill it this week.